Okay, let's dive right into this. Welcome to today's Explainer, where we're untangling one of the absolute most fascinating paradoxes in the market right now. We are looking at Vistra Corp. They're a massive power generation company sitting right at the dead center of the AI electricity boom. To really wrap our heads around the sheer scale we're talking about here, these massive tech giants are out there deploying computing clusters that literally consume the electricity of entire cities just to train a single language model. It is wild. But here's the paradox. Vistra is a company making more money right now than it ever has in its entire history. I mean, they are fundamentally dominating their sector, locking down these massive, multi-decade contracts with the deepest-pocketed tech giants in the world. And yet, if you've glanced at their stock chart recently, you'd legitimately think the sky was falling. So let's unpack exactly what happened here.
Negative 30%. Yeah, you heard that right. That is the incredibly violent stock drop Vistra experienced, plummeting from an all-time high of $196 a share in late 2025, right down into the $135 to $140 range by May of 2026. This presents us with just a tremendous mystery. Why on earth is the market mercilessly punishing a company that is undeniably providing the tech sector's single most urgent need, which of course is electricity? Well, to understand the deep value opportunity here, we have to completely separate the underlying physical financial reality of the business from the market's, manic mood swings.
All right, Section 1, the AI electricity hype and where expectations meet physical reality. To really get this, we need to quickly rewind back to that wild 2024-2025 AI euphoria. During that massive run-up, the market essentially treated AI electricity demand as this immediate overnight catalyst for Vistra's earnings. But they completely, fundamentally misunderstood how the actual power grid is built.
Just look at this quote from Vistra's CEO, Jim Burke. He is pinpointing the exact disconnect that caused the stock's rollercoaster ride. He says, "The physical world takes much longer to develop than what people might imagine." And he hits the nail right on the head. Software moves at the speed of light, right? You can write code and deploy a digital AI model to millions of users overnight. But you absolutely cannot build new power transmission lines, high-voltage transformers, and gigawatt-scale data centers overnight. The physical world is constrained by massive supply chain bottlenecks and these agonizing multi-year permitting processes. You can't just code a transmission line. So that initial market hype was highly irrational about the timeline. But, and this is absolutely vital to remember, the terminal demand is 100% real. That power will absolutely be needed, it's just taking a few extra years to physically pour the concrete and wire the whole shebang together.
Which brings us to Section 2, Vistra's physical moat. Or, simply put, you cannot download a nuclear plant. This is a cold, hard physical reality that the tech hyperscalers are rapidly waking up to. Realizing that relying on the standard power grid's transmission queue is going to delay their AI data centers by literally years, they are taking drastic action. Companies like Amazon Web Services and Meta, they are bypassing the grid entirely. They're signing massive 20-year direct agreements for Vistra's existing nuclear output at sites like Comanche Peak.
And this brilliantly illustrates why Vistra is in such a unique position when you stack them up against the competition. Look at Constellation. Great company, a pure-play nuclear operator. But Vistra actually offers a higher free cash flow yield and natural gas flexibility. That means Vistra can quickly ramp up generation when renewable sources like wind or solar suddenly drop off. Then you've got NextEra, a highly respected company, sure, but they are heavily regulated and require just massive capital expenditures to build out wind and solar fields from scratch. Vistra, on the other hand, is just a cash-flowing capital return engine. Why does that matter so much? Because their dispatchable nuclear and gas plants are already built. They're fully permitted and they're operating perfectly right now. They don't have to spend tens of billions of dollars navigating some 5-year construction cycle. They literally just sit back and collect the cash as grid constraints inevitably push wholesale power prices higher.
Moving on to Section 3, the power grid reality and a structural repricing of reliability. Let's zoom out and look at the actual macro environment. For the first time in 2 decades, U.S. electricity demand is completely decoupling from flatline GDP trends, driven by the electrification of the broader economy. And this absolute explosion of massive data centers, management is projecting an astonishing 5 to 6% annual load growth in the Texas ERCOT market straight through 2030. The American power grid has literally never had to handle a sustained demand surge like this in modern times.
So, this sets up a massive structural collision. It's like a giant puzzle where the pieces are moving in opposite directions. On one side, we have the rapid, scheduled retirement of highly reliable legacy coal assets all across the country. Due to aging fleets and environmental regulations, baseload power is leaving the grid fast.
But on the other side, we have an absolutely unyielding, surging demand from new AI data centers. The grid is essentially breaking down under the stress of this fundamental supply and demand imbalance. When highly reliable, round-the-clock power generation shrinks at the exact same moment that demand absolutely explodes, well, the intrinsic value of whatever reliable generation is left on the grid simply skyrockets.
And the financial result of that collision is staggering: $329.17. That was the clearing price per megawatt day for the PJM 2026-27 capacity auction. Now, it is absolutely critical to understand what this number actually represents. This payment is not for the electricity itself. No, this is essentially an insurance premium. It's a massive payment strictly for guaranteeing that their power plants are available to run if the grid ever gets stressed. It is essentially pure margin. And just to put that into perspective, Vistra cleared over 10 gigawatts of power in this region alone. That's enough to power millions of homes, and this record price, it's not some one-off anomaly. This represents a structural repricing of grid reliability across the whole nation, injecting billions in pure margin cash directly into Vistra's bottom line starting in mid-2026.
All right, Section 4, the gap accounting illusion, or why the algorithms got completely tricked. Because you're probably wondering, if the underlying company is securing such incredibly lucrative contracts, why the heck did the stock drop 30% in the first place? Well, a huge piece of the puzzle is this gap accounting illusion. Retail investors and quantitative trading algorithms essentially got fooled by the incredibly rigid, backward-looking way utility accounting works, which made it look like Vistra had a terrible financial year in 2025. Let's totally de-jargonify this dense accounting concept, because honestly, it's the secret to understanding the entire valuation disconnect. Vistra consistently hedges, meaning they pre-sell a portion of their future power output to lock in safe, predictable revenue. Now, imagine you agree to sell power at $50 next year. Suddenly, demand absolutely explodes, and the open market price for that exact same power jumps to $100. Well, on paper, under strict accounting rules, you have to record a massive $50 loss today on those pre-sold contracts, even though absolutely no cash left your pocket. That is called an unrealized hedge loss. Rising power prices hit their official earnings today with a massive paper penalty, but it absolutely guarantees that all their remaining, unhedged power will generate massively higher actual cash when the power is actually physically delivered tomorrow. The stark contrast is undeniable when you look at the 2025 metrics. If you just screened the stock using standard GAAP net income, you'd see a terribly weak $944 million. But that number is a total artificial illusion. It was dragged down by over $800 million in those purely paper hedge losses we just talked about. If you strip away the accounting artifacts and look at the reality, the actual operating cash flow hitting the company bank account, Vistra generated a massive $4.07 billion. Quantitative funds that trade mechanically off standard earnings completely sold the fake earnings miss, while the deeply analytical smart money saw a highly defensive business practically printing cash.
So, Section 5, Bull, Bear, and Base. Let's look at the probability-weighted scenarios. Now that the fast money retail crowd and those easily tricked algorithms have largely exited the stock, institutional value managers, specifically those growth at a reasonable price managers, are stepping in to capture the upside. Let's look at how the scenarios for the next 12 to 24 months actually shake out.
Looking at this valuation breakdown, we see a highly constructive setup. The base case, representing a 55% probability, targets a $185 fair value. This scenario plays out simply by sustaining current margins and executing their existing hyperscaler contracts perfectly. But look at that 25% bull case scenario targeting $245 a share. That represents a massive 79% upside from recent levels, completely achievable if AI demand continues to outstrip grid capacity and those sky-high auction prices remain structurally elevated well beyond 2027. And to be completely objective, there's a 20% probability assigned to a bear case of $95, which we really need to explore next to fully understand the whole risk profile. Because of course we have to objectively examine that 20% bear case. What could genuinely derail this entire thesis? First up, M&A indigestion. Vistra recently acquired a massive 8.1 gigawatts of new natural gas assets through Lotus and Cogentrix. Integrating complex physical assets flawlessly is a major operational challenge. Second, capacity market mean reversion. Remember the old market saying, high prices cure high prices? These massive auction payouts heavily incentivize new power plant construction, which could eventually bring those rates right back down to earth. And finally, regulatory intervention. Extreme power prices always invite extreme political scrutiny. State regulators could step in at literally any time to arbitrarily cap clearing prices to protect everyday retail ratepayers, and that would definitely put a hard ceiling on Vistra's upside.
Which brings us to Section 6, the final verdict: harvesting the intrinsic value. After fully analyzing the physical reality of the grid versus the emotional noise of the stock market, we can clearly see that the recent 30% drawdown was likely a very healthy cleansing. It washed out all the speculative, fast money froth from that early AI hype cycle, and it revealed a fundamentally dominant, utterly essential cash generator underneath.
And that leaves us with this exceptionally attractive number for the value investors paying attention, a 9.2% forward free cash flow yield. Right now, Vistra is trading at an incredibly cheap 9.0 times enterprise value to EBITDA multiple based on management's 2026 guidance. Just let that sink in for a second. Compared to highly respected pure-play peers like Constellation, which routinely trades way up at 14 times, Vistra is heavily, undeniably mispriced right now. The underlying cash generation of the business has totally decoupled from the recent negative momentum in the stock price.
So, what specific events are going to get the stock moving back up? Keep an eye out for these three massive catalysts over the coming year. First, the successful integration and immediate cash accretion of that $4 billion Cogentrix natural gas portfolio. Second, the announcement of entirely new hyperscaler colocation contracts, and not just at their legacy nuclear sites, but at their newly acquired natural gas sites too. And third, the aggressive, unyielding execution of their remaining $1.8 billion share buyback program. Management has already shrunk the outstanding share count by a staggering 30% since 2021. By continuing to aggressively buy back more stock at these depressed prices, they drastically increase the ownership stake for every remaining shareholder, geometrically compounding their free cash flow per share.
I want to leave you with this final thought to consider. We know that the digital software world moves at light speed, but the physical world simply does not. As AI demand continues to scale exponentially in the software realm, is the broader market still completely asleep at the wheel regarding the physical, heavy metal infrastructure required to literally power it all? Vistra's rock-solid 20-year contracts and booming operating cash flow strongly suggest the answer is yes. The temporary disconnect between tech hype and physical energy reality is exactly where the true opportunity lies. Thanks for joining me on this explainer, and hey, keep your eyes on the grid.